Welcome to the Cashflow Academy podcast. I'm Andy Tanner, your host. This is where we do our very best to make all things investing simple. Got a great show, a very timely show, very important episode. As we hop in, don't forget to drop by yourinvestingclass.com. That's yourinvestingclass.com for lots of education, goodies, and important things. So if you haven't dropped by there in a while, drop by. My guest is Sean Vanatta, and he's written a book called Plastic Capitalism: Banks, Credit Cards, and the End of Financial Control. And it's an interesting title because I've always taught that risk is related to control. And the more control you have over investment, the less risk you take, and the less control you have, the more vulnerable you are to risk. So we're going to introduce Dr. Sean Venata. Welcome to the program, and thanks for spending some time with us.
Andy, I'm really delighted to be here, and I'm really happy for the chance to chat about my book.
So let's start with your background, if you would, just a little bit about how you grew up, where you grew up, and then your background, your experience, and really what motivated you as someone who's written a couple of books. Something usually hits you enough to, if you're going to do the work to write a book. So what motivated the passion behind the book?
Absolutely, yeah. I grew up in Savannah, Georgia. I went to UGA as an undergraduate, and that's where I got my first credit card. And to some extent, right, that's part of the motivation for the project. I'll maybe say more about that in a second, but yeah, I just grew up in a family where my dad really liked history. I always liked history growing up. As an undergrad, kind of got a history degree because I had the credits and it was kind of a fun thing to do. I got a marketing degree because I wanted to get a job and have a career.
Yeah.
And then I went to work in marketing and I hated it. I came away thinking like, well, there was a reason why I got A's in my history courses and B's in my marketing courses. Maybe I should see what history has to offer. And it took a while to kind of get a sense of like the profession of what it means to be an academic and do like serious historical research. So I was back at Georgia
Yeah.
for a while, enjoyed a few more football seasons, and then ended up at Princeton working on this project. And part of the motivation was just that I felt like I didn't know anything about finance. I started my uh, sort of master's at Georgia just as the financial crisis was starting. I was just getting introduced to all the sort of intricacies and technicalities and the things that made, at least at that point, right, the global mortgage market and then the kind of explosion of that market that we all then suffered through for a decade. So, it's just like seeing that these things that you kind of that are working in the background that are immensely powerful for our day-to-day lives are something that most of us just don't understand. And so I really wanted to take on some kind of financial history topic. And then that experience as an undergraduate, getting a credit card and then using it irresponsibly, racking up credit card debt and then struggling to pay it down, helped me to think about, on the one hand, like why in American society was that sort of a usual story, right? Why do we have so much high interest debt as just part of our economic system? And then I kind of questioned too about how did that system come to exist, right? How did banks get into the credit card market in the first place? How did government respond in terms of regulation or not regulation? And how then did we get to the point where, I mean, at that time we were about $1 trillion of credit card debt, and now we're 1.3, 1.4. So it's just
Yeah.
been, this continuous increase in high interest debt through these products that we just use on a daily basis as though they are money. But, for some people, there's really serious consequences. And so I just wanted to try to understand that story coming out of my own experience and then trying to extrapolate that experience to the broader
I,
U.S.
I
economy.
think I think this is an important book, an important topic for a couple of reasons. Not only on the consumer side, but also on the investor side. So we'll dive into both of those ideas. Um, I absolutely love history. It's so strange. I was a terrible student in school. I just didn't like the context and the environment of it. Go do this and you have to. And I think it was a lot of the entrepreneurial spirit in me as a young man that just didn't want to be told what to do.
Yeah.
And so I didn't discover the amazing richness and lessons of history till I got older. And I'm really excited actually to delve into the history of the credit card. I remember when I first saw a Visa card when I was a young kid, and I remember the environment of it very well. But I'd like you to walk us through that because often, and I'm curious to know how you feel about the history of this. I wrote a book on 401ks, and people have no idea. The 401k was not designed as a machine to help you retire. It's more like the evolution of a beast. It's more like evolution than it is design. And I'm sure there's some elements of that in the credit card. So, two questions, kind of a one-two punch. Tell us a little bit about the emergence of credit cards and what the banks had in mind when they decided to do this. Because I remember my parents and everyone. It was evil. I mean, people were like, oh, this is going to be bad. We're not doing this. And then more and more stores started accepting credit. And but I'll let you tell the story.
Yeah, I mean, it's like we have to go back to like the 19 teens, 1920s, to start with the kind of first question, right? Where does the credit card come from? And it comes from people going and shopping in big department stores like downtown New
Yeah.
York, Macy's. And there, what the department stores understood is that if you give people credit, then they'll buy more stuff.
Okay.
And so it's part of a kind of like store-based marketing scheme where if we find, affluent shoppers, people who we know have the credit, have the capability to pay, if we give them credit, if we treat them like someone important, someone special, then they'll buy more. And so what the way that these are programs are called charge accounts, the way they would work is you would essentially have a no interest loan from the store for 30 days or 60 days, which you'd have to pay off every month. So you couldn't carry the balance, but you'd get 30 days of credit. And again, it's kind of the prestige factor. And that sounds simple enough, but you then have to think about how you manage a program like that and how there's a whole kind of accounting and billing system that goes on behind that. And so there's a process in the back office of mechanization so that that kind of interpersonal relationship with, the elite women shoppers that you're engaging with is something that you can manage in the back office. And so that's where the kind of physical card, you can imagine, like you can remember credit cards used to be embossed, and this comes from
Yep.
that where you'd have a customer's name and address exactly
Yep.
and account number. You do the little, the carbon paper that would then
Yep.
enable you to have a bill that you could send to their house. So there's this whole kind of process that's connecting this product, the charge account, to a technology, to the credit card, which is both this kind of identification mechanism, but also ties into the credit
Yeah.
system. So that develops in department stores. Over time, for a variety of
Just
reasons, yeah,
just to interject, this might add some richness to your story. That's an interesting story that triggered my childhood. I'd like to share with you at this point in your story. So when I was 12 years old, I had a little suit for church, and I put on my suit and I marched down to a department store. It was actually a furniture store, not a department store. And the name of the store was R.C. Willey. And I worked there, in the summers mowing lawns, and then when school was out, and then when I got older, I got a part-time job in their warehouse running a forklift, and they did this, and just to give people some context of how big this was, the or the regional banks. I grew up in Salt Lake City, Utah, and the regional banks were Zions Bank, First Security Bank, and Walker Bank. Those were the three big ones. And the manager kind of took me on his wing, and he was just a great guy. And he showed me something once. And he took me in. They had the little green, the computers were green. They had a green screen with green letters on it. And RC Willey was the second largest creditor in the state of Utah. It was bigger. There was one bank that still had more credit people in Hawk, and he said, Andy, we don't make any money off our cash purchases. We sell our furniture at the lowest price possible. If someone pays cash, pretty much breaking even. It's the credit where we make our money. And it was so big, and it was interesting because about 5 or 6 years later, Warren Buffett bought that business. And the reason he bought is the same reason he bought American Express. So I thought I'd just share that personal. At 12 years old, that's the first I really learned about this. It was a furniture store, very similar to what you're saying, like Sears or what have you. The second largest lender in Utah was a furniture store.
I believe it. Well, I mean, Sears and J.C. Penney especially were the largest
Yeah,
consumer lenders. Even
yeah,
as, part of my story is how banks are getting into the market. But until the 1970s, those are the big players in consumer credit. And
yeah,
anyone's experience with a credit card, more likely than not, would have been with those companies rather than with banks. And part of the reason banks get into credit cards at all is because, right, you think about a commercial bank, they're dealing with small businesses. And it's that department store chain moving into your town or opening up a branch in the suburbs and offering that credit that scares the small businesses, right? They want to offer the same service, but they can't. They can't
yeah.
afford, to set
Tracking
up.
and figure, yeah, all that.
And so the banks begin to think, well, this is something that we could do, and we could then take over the kind of consumer credit relationships that maybe those stores have with their local customers. We could get an inroad into consumer and retail banking. So you see these kind of small scale credit card plans that grow up, in Long Island, in Kalamazoo, Michigan, of all places, that eventually the bigger banks sort of see this and decide to give the industry a try. So in 1958, Bank of America, which is in California, Chase Manhattan Bank in New York, both enter the credit card market. And it's really Bank of America that sets the model. But what makes them so successful is that instead of focusing on the merchant side of the business, which is what the early banks did, Bank of America already was a huge retail bank. They had millions of depositors. And so they just mailed out unsolicited credit cards to all their depositors. And they basically said to the merchants, listen, we just gave our customers credit cards. Now, do you think it'd be a good idea for you to take these cards? Because they're going to expect you to take them. So why don't you sign up for our program? So as a way, essentially, one way to create a market, right, is to sign up the merchants and then have the customers join because the merchants take the credit. The other way is to sign up all the consumers, and that's what Bank of America does.
That's a really important part of the story because there's an inertia. I mean, that's a pretty massive change going from writing a check, which was traditional, or having cash. That were your two modes, really. That's a pretty big change to do something new in a spending habit, because spending habits are a huge thing. So I've always wondered that very question, which came first, the chicken or the egg type of a thing, because that's a major change. So it looks like the merchants, they said, hey, they almost got, I wouldn't say strong arm into it, but they were certainly saw the benefits.
I would actually say they were strong-armed into it. I mean, the Bank of America is pretty explicit about it, and so are the other banks once they get in, that once the consumers have the cards, then the merchants aren't really going to have a choice.
Yeah.
And so that's part of this dynamic about essentially power over the ways that people spend and how they spend and what they use to spend. And so again, it like the kind of industry adoption is a similar story to the kind of department store versus small store. But then it's Bank of America, which has the Bank America card, against all the other banks that want to enter the credit card industry, but maybe basically Bank of America promises to license the Bank America card to big banks around the country. All the other banks feel like this is a major kind of competitive problem. They begin to organize first kind of city or regional networks, and then they
Hmm.
organize what become MasterCard. And I've got like, if you're watching on the YouTube, right, like,
Yeah, you
there's
got
the
him.
Pittsburgh National Bank, you've got, the First Bank in Seattle, you've got Marine Midland Bank, which is in upstate New York. These are all banks which come together into what becomes MasterCharge and then MasterCard. And this is in the mid 60s. And what all the banks do is they just copy Bank of America. They say, you know what? The only way to get into this market is to mass mail these cards. And so you have this period in the late 60s where there's just tens of millions of unsolicited credit cards going into the mail, where, this is before card authorization. So it's not like you're calling in and providing your details and
Right.
like the card is ready to go. So if someone steals it out of the mail, right, there's massive fraud problems. It's a total
Yeah.
disaster. But bankers are really convinced, right? Part of what's important to understand about this period is after the New Deal in the 1930s, there's this huge effort to make banking safe, right? All these regulations put on banks. Banks are meant to be simple, safe businesses. And that also means that they're not making a lot of profits. And they see consumers, they see the way the American economy is driven by consumption, driven by credit spending. And so they see like the credit card as the road to the future. This is new technology. This is ways to access consumers. This is ways to grow geographically. Banks, either you'd have like unit banks in places like Illinois where they couldn't have branches. All of this kind of motivated banks to go all in on the credit card market in the 1960s, and it ended up being kind of a disaster. On the one hand, there's all this unsolicited mailing, and then it kind of begins to generate a massive consumer backlash that leads to more regulation, which is exactly what the banks had been trying to avoid.
So, interesting history, interesting stuff. We're going to take a short break. When we come back, we're going to talk about the state of things now and today and what's happened. And it's an interesting story that is brought to bear. And it's a very, very important time for investors to be connected to the statistics and where this is headed. So, when we come back, we're going to be speaking about the future and the present state of consumer debt and credit card debt.
They make different topics that could be complex very simple. You're going to learn at your own pace. The more that you want to learn, the more you can learn. It's been amazing for me personally, as well as me taking the subject matter and teaching it to my children. They're all very passionate about what it is they're teaching and how they teach it, and it just comes across as so genuine. If it's something that you're interested in, then certainly they're the best teachers that I've run across in terms of teaching fiscal education.
We're back and we're speaking about credit cards, and the book is Plastic Capitalism, Banks, Credit Cards, and the End of Financial Control. Very important discussion. We've talked a little bit about the history of how this came about. There's been some unintended consequences, and I've heard debt referred to as a lot of different things. One of the great definitions I think could be a way to think about it is a claim on future earnings. That the more you swipe that thing, the more of your future work is it's been claimed. There it is. And there are certain things that I think I think really work well. I think home ownership, while I'd much prefer to have a income from a rental property than expense of my home. I was telling my son what we pay in property taxes, and he about fell over. I says, "You never really own your home, son. We rent this from the county." And this is how they pay for schools, and this is how they pay for local stuff. You pay you pay your rent to be here. So I can see where, though, a mortgage and a home, it makes sense for your life. It's good to have a place to be grounded and rooted and raise your family. But consumer debt, very rarely do I give a nod to Dave and Susie, because I think differently than they do. I think discipline is not creative; it's just discipline, right? It's not a wealth creator, but you have to start with discipline to not be out of control. So, give us some numbers and give us some statistics of where we are today, and tell us where we are in credit card debt today.
Yeah, I mean, I think if you look at, I sort of think about credit card debt like it's an interesting story just in the last, I don't know, 15 years. We're coming up to the financial crisis. There's this story of just like uninterrupted expansion, doubling every 5 years for 2 decades, basically. And I'll
Yeah.
say maybe a bit more about why that is in a second. But it's kind of just shows the way that the US economy is just totally dependent on this consumer spending. You get the financial crisis, there's a dip as people are defaulting, as people are trying to repay their balances, gradual increase until COVID, drop again as the economy drops, but then we've just shot up.
Since
Right?
since COVID, it's amazing because we injected trillions into the economy. I mean, there's money everywhere. We're swimming in money, and yet still, the habit, or I don't know what it is psychologically, but the numbers today are just nothing short of astounding. The amount of future earnings that have been claimed already.
And I think, I mean, you could think about this as like as both the past and the future, right? One way to tell the story is the boom in credit card debt starts when the boom in inflation starts. And so that's the difference, arguably, between the rising cost of goods and then wages trying to catch up, right? So your spending habits are the same. It's just all of a sudden the things you used to buy are more expensive and your income hasn't gone up.
Yeah.
And so for a large percentage of the population, I think that story probably holds. A second part of that is that as the Fed then tried to combat inflation, as interest rates go up, credit card interest rates go way up. I mean, it's
Now
really shocking to
that
look at it.
to me, that's a really interesting thing, because I would never, as an investor, have an interest in variable rate. Your book is insightful. I said at the top of the show, the end of financial control. That's not just a cute subtitle. That's very meaningful, actually, because if you're in a variable situation, you do not have control over that rate. So that's very accurate. And to me, it'd be unthinkable to buy a home, residence or rental property, and not have control of that rate and say that's what it is. I got to have that fixed. I got that locked in. And to have variable rates, my wife was mentioning, we don't use credit in terms. I mean, I swipe my credit card all the time, but there's a period where everyone knows that you pay it, and you don't have to any interest charged. And as the interest rates have climbed, like you said, the disproportionality, is that a word? Of you have this increase in federal funds rate, which is really a floor on interest rates. But I mean, these credit cards are approaching, between 20 and 30%. And
Yeah,
to
I
me,
think
that's
recent offers have been around 36% as your rate.
I mean, that's a third. Can you imagine, spend $1,000 and you have 300 a year that you're going to fork over extra on that? That's astounding.
It's astounding. So I think like part of what the book is trying to do is explain where that comes from, because just as you say, no one wants variable rates, especially for this kind of debt. And
Yeah.
so, as I said, as I was talking about earlier, right, there's this big boom in credit cards and there's this process of regulation. And part of that is creating state level caps on credit card interest rates. So saying that banks, you cannot charge more than 18%. And part of what this does is it shifts that risk onto the banks themselves. So if market rates go up, they can't charge any more than 18%. So they're not going to invest long term in consumer debt because they face interest rate risk. But once you get rid of those state rates, which is a process that begins in the 1980s when banks start to move around between different states, then you create the conditions where you can have those variable rates for consumers. And so as we've seen recently, right, the average rates for consumers go from 14, 15% across all credit card balances to averaging like 25%, which is, again, just like it's mind bending. I don't know, to think about
It,
across millions of consumers who, are struggling with inflation already, who are racking up these balances to make ends meet, and then to watch your rates go up and your monthly payments increase on top of that. You can get a sense of why, like, even though the economy is doing well, why a lot of people don't experience that, right? That even if your pay has increased 2 or 3%, if your credit card bill is going up even more than that, you're always just chasing.
yes.
So
There's an idea out there, and if you want to talk, I avoid the topics of politics and religion like you're supposed to, because it's conversational nitroglycerin. It's just scary. So I don't really talk much about parties. I tell you the truth, I'm tired of I just want to live, right? Just right in the middle. Just let other people worry about that. I will say this: if there's a narrative ever that talks about something for nothing, something that you deserve without an equal amount of effort to obtain it, something for nothing, that's kind of frightening to me, because when you think about money printing and the idea that, look, you need to have these things, and so we're going to use the collective to take care of this. Well, that'd be fine, but if you're going in debt, you're making a claim on the future earnings of the collective. And there is a limit to those types of things. And I think about Silicon Valley Bank, which is really interesting, is they were a victim of interest rate hike. In other words, they had purchased bonds that were low interest. I mean, we had close to a zero, yield on things for a long, long time. Debt was cheap, money was cheap, as an answer to a financial crisis, make money cheap to borrow. And what that does is it enables spending. It enables people to spend, but it's a claim on future earnings. And that's really important to understand, is that when I collect money from a credit card, that's spendable cash for me, but it's future earnings for the person that did that. And it's really, really important to do that wisely, to invest like in a home. I don't have a problem with debt for investment. I have all kinds of debt for investment, but it cash flows. It has a return to it. And what I think is interesting about Silicon Valley Bank is when the interest rates, skyrocketed there, why would I want to buy a bond from them when I can buy one for the same $1,000 and get so much better interest? And it collapsed that bank. Well, I think that people should think about that on a household level. Is that if all of a sudden we print all this money to try to solve all these problems, let's say I paid $100 for something. Well, now I'm paying 130 for it because they're going to jack my. So not only are the products becoming more expensive in the future, the products that I bought in the past, if I did on credit, have now become inflated. Is that accurate, or is that overly simplistic?
Well, I mean, I think I'd say this has been a debate since we started with consumer credit in the 19
Yeah,
teens. And exactly the term that you use, this claim on future income, you just have this idea that okay, in this cycle, we've paid for, all the factories and all the services and all the productive work with our wages plus some credit, right?
yeah,
So you get to the
yeah,
next cycle, well, part of what we had has to go to interest. And
yeah,
we're trying to grow, we want more. So where's the next cycle going to come from? Where's the next cycle? And the more we mortgage our future income to our current expenses, then there has to be some point where all of a sudden the kind of system breaks, right?
yeah, yeah,
Where we just don't have the current income to service the debt from the past and also generate the growth in the future. And yeah, I think I would say I don't have an insight into the big picture market mechanics but I think a story that you could tell is that part of what the Fed's actions are doing, part of what sort of pushing more and more liquidity into the market is doing, is solving that problem temporarily. But it then
yeah,
just enables, then the debt just keeps growing, right?
yeah,
It creates this thing where we've had an economy, again, since for a very, very long time, that's been rooted in consumer and household debt. And some of that arguably is good in terms of mortgages, right? It's debt for investment that appreciate in value and lead to household wealth generation. But it's also debt for all the stuff that goes in the houses, right?
and
That isn't.
that's rough. That's rough. I look at it, it's really interesting, because one person's liability is another person's asset. And as an investor, the thing I'm currently researching. I mean, I'm currently trying to figure it out, because the problem is let's just take American Express, for example. Now, Warren Buffett owns it, and obviously he wants to be on the side of collecting this interest, not paying it. And the problem is the asset's only an asset if they pay it. So, take my mortgage, for example. If I have a mortgage on a rental property, that mortgage on that rental property is my liability is the owner of the rental property, but it's an asset to the bank as long as I pay it. So if I get into in the 2000s, where everyone's getting a mortgage, a zero down, talk about sending credit cards to people in the mail, zero down, stated income, no documentation, pre-approved loan for anybody, interest only, whatever you want to call it, these crazy mortgage and debt products. That's just a huge liability to me, and it's supposed to be an asset to the bank unless I stop paying. And then that asset actually becomes toxic because now they've purchased something, as they purchase the debt that's not going to pay them back. And so you've actually, you bought a bomb, you bought a lemon. And that's really what, and I thought when they call it in the financial crisis, at first they call it the toxic asset protection program, and some PR guy said toxic. You really want to use that word about you have the Fed buy toxic assets? They go, oh, it's troubled. These assets are troubled. And I think as an investor, and I like your opinion on this, and if you say, hey, Andy, it's outside my wheelhouse, I'll take it, but I have to ask. As I look at purchasing banks, Buffett sold a lot of banks, and there's a backstop, kind of a Fed put option, if you will, where a lot of investors will say, you know what, I don't mind buying an Amex, and I don't mind buying these, because even if people get to the point where they're defaulting and the default rate comes up, the Fed they'll bundle all these together, and the Fed will buy them up with printed money, and the banks will always win. So as an investor, one of the things I want to know, and one of the things I'm looking at is I look at, do I want to invest in finance right now and be a beneficiary of these insane, rates that are just awesome for a bank? Or do I say these could be troubled assets? Maybe it's time maybe the banking industry is ready for a reset. I just like your opinion on credit on the other side as an investor. Man, if you know anything about compounding, anything about it, if you're compounding at 33%, you're going to get absolutely annihilated if that's a compounding cost. And you're going to absolutely get filthy, stinking, vulgar rich if you're on the other side of that stuff. So when people say, well, there's this debate goes on, I go, look, let's just have an 8th grade lesson on compounding. And if someone's costs are compounding at 33, that's not hard to figure out where that goes. Problem is it goes bad, my asset becomes toxic. Could you comment on that? And if you care not to,
No, I'd
because
love to. In
sometimes
this
sometimes a
way,
historian doesn't want to
I
go
will.
there.
I'll say a few things. One, I mean, so part of it is it's just an unfair question in that my book is just about how, like,
Sure.
really, this credit card system is not good.
Yeah, yeah,
Um,
yeah.
and how just like generally we've set ourselves up. We wanted to avoid it. We worked politically to avoid it. We tried to contain it,
Here we
and we
are.
don't live in that world, right?
Yes.
And so I can't in good conscience say, yes, you should buy bank stocks. What I will say that for the point of the program, if you look at the Federal Reserve after 2008, the Federal Reserve
Oh,
was required to publish data on the
yeah.
profitability of bank credit card plans, and
Yeah.
specifically of like these credit card banks that are just chartered to issue cards. And the Fed has just demonstrated that credit cards are by far one of the most profitable lines of business for banks over this period. And that, as we've talked about, right, that's before these rates have gone super sky high. What the Consumer Financial Protection Bureau has shown is that banks, like if you look at the Fed funds rate kind of going up with inflation, or as a result of Fed reactionary inflation,
Yeah,
you
yeah.
look at the prime rate, it kind of moves with the Fed funds rate. Credit card rates go up faster, right? So they're
Yeah,
increasing by a higher magnitude
that's that
than.
disproportionality we talked about, right?
So yeah, so it's like as long as you have some confidence that consumer defaults aren't going to really skyrocket. And we just got, like, I think just before we came on, there was some data from the Labor Department showing that job growth had actually been much slower than they previously reported. Part of what I've seen, right, is credit card debt has peaked, I think, or is near what looks like a peak. We don't know because we haven't seen it start going down yet. All sorts of signals about the future of the economy being in question. And
Yes.
when that happens, default rates are probably going to go up. And so you then are kind of stuck with, yeah, you're trying to guess, one, what's going to happen, and also two, what do other investors think is going to happen? Because if enough people think that this is a bad story for banks, then, you know, you might have a bargain in terms of purchasing at a price that doesn't quite reflect how bad or good things might be in the end.
Yeah.
So again, I cannot advise you to buy bank stocks because I think credit cards are evil. But looked at objectively, I think you could do your own analysis and try to think through what the future is likely to bring. And if you think that default rates aren't going to outweigh those, what would you say, interest rates that will make you vulgar rich,
Yeah.
then
Yeah. Crazy, right? I think there's it is a real question, and it's just one of those things. There's so many different, levers in the economy that we look at. And I'm actually concerned. I'm usually, I'm a stock guy. I'm like, own stocks, own stocks. If you're a cash flow guy, you'll be fine. But if you're one of these guys that's trying to capital gain all the time, be careful right now, because this is just one. There's talk of forgiving student loan debt. I think there could be talk of forgiving credit card debt. I could see a narrative of that, by the way. These predatory people. I mean, credit card, the philosophy is a lot like gambling. Gambling has been sold as entertainment. Now, it's morally questionable, and morally questionable enough that it's illegal in most states. They have little lotteries and ways around it, but basically, it's Atlantic City and Vegas have been the mainstays of this stuff. And they're basically, it's an operation that transfers money from the pockets of one party to another as the machine turns, and they sell it under the guise of entertainment, which is really about dopamine. It's just a dopamine hit. Well, shopping uh, is a form of entertainment. It's something. Hey, what do you want to do? Well, let's go shopping. Let's go shopping. Let's go. And there's a dopamine hit associated with that. And I could absolutely see a narrative that says these guys have exploited these guys. We should forgive all this, but it's just going to exacerbate it, because you still can't eliminate that there was no, if you print the money out of nothing, you're stealing it anyway from the savings account. So this narrative of something for nothing, I just don't see why it ever ends well. There seems to be a yin and a yang to doing work and getting value for the work you do that is just so unavoidable. So it's an interesting conversation right now. Let me give the name of the book again. This is called Plastic
can you go
Capitalism.
and show it? I think it's got an awesome
Oh,
cover.
please
So
do. Yeah. Oh, hey, let me tell you, I love plugs, and my listeners are accustomed to this. It's so good.
product
My
placement. There we go. Yeah.
my listeners are accustomed to this, because I always tell them, there's some of they've told me, it says, hey, you don't want your podcast to be an infomercial for books, but I will tell you how you're going to learn anything. And if it's worth talking about, it's worth delving into deeper. I always tell people, when you hear a guest that I brought on, it's because I want to have a conversation. If you're ever in Salt Lake, or I'm over there, if I get across the pond, well, then shoot, we're going to have dinner together, and I'm going to pick your brain like crazy. Well, that's what books allow you to do, is take an expert who's really studied the field, and I guarantee you're going to get insights that you wouldn't have got otherwise. So, read and study and listen and go beyond just the podcast. And books are a great investment for people who are interested in success. Coaches are even better for people who are committed to success. And that's really the difference. So if you're interested in learning more, read his book. If you're committed to learning more, then get a coach and get teachers that can really walk you through this. It's Plastic Capitalism, Banks, Credit Cards, and the End of Financial Control. Learn the history. I've learned so much I learned this from my mentor, Robert Kiyosaki, about the importance of understanding history. Because if you want to know how the future works, there's this saying that says history will often repeat itself. And as you learn what happened in the past, it's not a guarantee, but you do have some insights and some things to talk about for the future. Anything as we part, a big thank you. Anything for listeners as you look back at your body of work in this study, and it takes a lot to write a book. You learn. Uh, I tell people, if you want to learn something, don't read the book, write one. Right? I mean, you learn so much. Summing it all up, when you put the final period on there and send it to the publisher, what did you gain, and what would you tell people? The most important thing you've learned in the process.
Oh man, that's a big life question, right?
Yeah, yeah,
Yeah, I think I think on the one hand, there's a kind of big question about how we organize our economy and society, right? And so again,
Yeah.
we're not talking about politics in particular, but it is a big question about how we got to a place where consumer debt, household spending, is such an engine for the economy. And a question then about like what are the ways out of that? It's not obvious to me. I feel like that was one of the main, maybe almost disappointments of the process. I can't tell you what the answer is, right? I feel like there's a problem and we can see it in all different ways. As you said, student loan debt, there are all these different symptoms of this problem. But it's then trying to figure out collectively how we want to deal with that. And I just don't think that we have a lot of solutions available. And then I think just as you say, right, it's the process of learning, right? History isn't facts and dates and the kind of boring stuff that we dread from school. It's actually really trying to dig into people's lives and understand the circumstances that they were in at the time and why they made the decisions that they made. And it's that engagement with other people who now, are mostly dead in the case of historians that makes the work really interesting and I think meaningful. It's about understanding people's lives. It's about understanding their humanity and the decisions that they confronted, and then taking that humanity out into your daily existence with other people who you can interact with. So
I think there's a great thing that everyone can learn from this book is, if someone came to me and asked me, I've got some credit card debt, I'm feeling the heat, what do I do about this? I'd say, well, a couple of things. Change how you spend and change how you borrow, because you can, this is very rich dad, poor dad. It's pretty basic. You have these things called doodads, which is a set of designer jeans and, stuff that's going to be in the landfill. But you can also use your buying choices to buy things that turn the interest in your favor. In other words, instead of swiping something that's going to cost me 30%, we'll find something that I can buy that might give me 1%. And then if you can use debt, if you can swipe your credit card, so to speak, for something that pays you more than the interest you pay, you've got a complete cash cow. And that's, to me, that's all real estate is that, the rents that I'm going to bring in for giving a good value to that person. And I love the fixed rate, because right now, I've got some great tenants and I haven't raised their rents. I probably should, but they've been good tenants and they're solid. So I actually, because of fixed rate debt, I don't need to raise their rents like maybe some people, like I probably should, but I don't have to. And I hope that those tenants are like, man, I'm getting a deal right now, and I'm going to stay here. I'm going to take care of this property because Andy can provide me a better value than anyone I'm looking around here. And it's simply because I've used the debt in a fixed way where I can compete if I want to. I could raise prices or I could not. And when I use that debt, if the amount of money that I'm receiving is bigger than the payment that I'm paying, how many times can you do that? You can do it an unlimited amount of times. So if someone's in credit card debt, I would say, you can Dave Ramsey and Susie Orman this all you want. It's going to take a long damn time to, cut one up and start paying the big one off, and then you get to ring the bell. Or you can learn to use this tool to get you out of trouble. You can fight fire with fire, and you can get out of trouble faster than you actually got into trouble. But it starts with education, and it starts with going to Amazon.com, and it starts with, this is your cue to hold up the book again. It starts with getting plastic capitalism, banks, credit cards, and the end of financial control. Remember, risk is related to control. Take control of this, learn about it, and you'll be better off. Dr. Sean, if you'd hang on a bit so I can properly thank you. You've been listening and watching the Cashflow Academy podcast. I'm your host, Andy Tanner, and this is where we do our best to just make it simple, right? In this case, buy different stuff, buy stuff that pays you more than before. It's a pretty simple idea there. We love that you've listened. We hope that you take the opportunity to learn always. Go to yourinvestingclass.com. If you learn how to buy stuff the right way and change it, well, don't just be a disciplinarian, be creative and start buying things that pay you. And don't just try to do this with a job alone. It's going to take you a long time to get out of credit card debt. Learn to be an investor. That's our show. We'll see you next time.